Hello, what's up, guys? So, this is IFRS, an ACC affiliate, and today I just thought let's cover some common questions from IFRS 9 that is about hedge accounting and derivatives. And, let's get to know some terminologies, what is the criteria for hedge effectiveness or for, a contract to be known as a derivative or it to be valued according to fair value accounting or whatever it is, and how to make the decision between cash flow or fair value hedge and so on. And because there are many questions associated with that in the SBR, so I just thought let's just decode this entire technical article and let's get started. So no time to waste. And I know you guys might be like, how complex this video might get and so on, but no, my point is to try to make it as simple as possible and as easy, easy peasy for the exam as possible. So let's get started. I'm so excited. So as always, my computer has to glitch. So please follow this part, guys. I'm not going to edit this video much because I just want to be without a filter and just keep speaking and explaining and helping you decode this topic. Why is this not working? Okay, no worries. It's okay. So, guys, here it is talking about derivatives. The article covers about derivatives in hedge accounting. Okay. Here it is, derivatives and hedge accounting. So, according to IFRS 9, financial instruments, a derivative is a contract that will be settled at a future date, requires no or low initial investment, changes value in response to movements in the underlying items such as commodity price or interest rates. So, it's just like you're trying to hedge yourself or you're trying to manage your risk associated to change in prices of a commodity that you're trying to sell to the public and so on. Mostly the questions will be related to that. You're just trying to lock up a price. If there's an increase, it's good, of course, but if there's a decline in your price that you're going to sell to the people, of course it's a loss in your profits, right? So you're trying to lock that through derivatives. That's all, guys. Nothing complicated. Okay, and accounting for it is going to be even more simpler. I don't know why people think it's complicated. So and I don't know why people don't read technical articles. Like, why? Everything is just written down. And also, why don't people subscribe in my channel? Because I'm really going to decode everything. But okay, whatever. Sorry, guys. I'm just. Uh, Derivatives can be used by companies to manage risk. For example, a company that manufactures bread may reduce its exposure to changes in price of wheat by entering into a futures contract to buy wheat for a fixed price in 6 months' time. So sometimes, if the wheat price is associated to the bread, that will increase. They would like to hedge for it against that. So it's not like the hedge contract will help you to reduce the price. No, whatever loss will happen as a result of the increase in price in the wheat price, that loss it will try to offset using the gain coming from that hedging contract, right? One gain will come up from that hedging contract, and that loss that was there, that will be netted off against the gain. And therefore, your loss will reduce or your loss will come to nil or whatever it is. That's how hedging contracts work. So people think hedging will help us reduce the wheat price. No, that's not how it is. Any beginner will think that way, or they might not be aware of this concept. So let me just decode it for you. And these contracts will be settled net in cash. If wheat prices rise, the company will make a gain on the contracts. If wheat prices fall, the company will make a loss. Net in cash is one of the words that you should look for in the exams, like keyword. Net in cash means, okay, it's going to be a derivative and it's going to be a hedge accounting. This scenario is there and I have to plan my answer accordingly. So yeah, if wheat prices rise, the company will make a gain. If wheat price fall, the company will make a loss. Of course, wheat prices will rise. Um, Gain on the contracts. Okay, one more thing. Gain on the hedging contracts. If the wheat prices, go up, it will be a loss for us. But we have a hedging contract which is going to help us offset that loss. So again, if you want a gain on the contract, it will work opposite to that wheat contract, the buying contract, right? I am going to get wheat contracts. I am going to buy wheat on a certain price. That certain price is decided by my hedging instrument. Okay, what it is saying is that I can only gain I can only get my gains via the hedging instrument if my wheat prices increase. Simple, guys. If my wheat prices increase, that means we got that hedging contract for netting off the loss that is coming from the wheat contract. Good that we took it on a timely basis, such that we are getting gain here, and we are going to offset that towards the loss coming from the wheat contract. So this is what it is saying. This contract, this company will make a gain on the contracts if the wheat prices rise. This is what it means by that. So don't confuse it. Don't be like, what is this saying? Gain on wheat contracts by rise in wheat prices? That means we'll have to buy at a higher price? No. The hedging contracts is the contracts referred to here. So please understand this. All derivatives are measured at fair value. Okay, changes in fair value are recognized in profit or loss unless the entity has elected to apply hedge accounting by designating the derivative as a hedging instrument in an eligible hedging relationship. Okay, so what happens is sometimes derivative contracts can be, according to a hedge accounting, according to this specific. That's why I kept the screen open because I know this is going to come up. So sometimes they apply this hedge accounting thing for derivatives, which will, yeah. So all derivatives measure fair value changes in fair value are recognized in profit or loss unless the entity has elected to apply hedge accounting by designing the derivative as a hedging instrument in eligibility. So what happens is usually derivative contracts accounting is P&L. Whatever gains are there, credit to P&L. Losses are there, debit to P&L, just like that. And the associated item which we are hedging, for example, if it's an inventory item that we are hedging, or if it is a particular commodity price we are hedging, that will not be affected. We are not going to increase that inventory item at all. We are not going to touch that item that we are hedging. We are just going to simply record the gains and losses coming from the hedging contract. That's it. So here, what is the problem? Problem is we are not trying to match the effect with the balance sheet. So our EPS will appear very volatile. We'll be like, continuous some gains are coming up in our earnings, which is fine if there's a huge gain and all. But suddenly, if there's a lot of gain in 1 year and in another year there's lesser gain, in a third year there is much more gain, such things happen. Of course, this creates a volatility. But at the same time, what hedge accounting does here is that whatever gains and losses are coming up, if it is fair value hedge accounting, which we'll cover more in detail now, if it is fair value hedge accounting, you are going to recognize those gains and losses in the respective item also, inventory item also. That matching thing is there. So that effect is reflected everywhere. Or at the same time, if cash flow hedge accounting is used, for example, you are going to recognize the gains or losses in that, gains in the OCI or the losses in the OCI, depends, related to that hedging contract. And then when any actual transaction takes place, because it is usually done on forecast transactions, whatever is going to happen in the future, not now. The cash will be done, the cash transaction will take place in the future, not now. So we are going to hedge for that now. So what we are doing is we are recognizing an OCI and then we transfer it to PNL once the actual transaction takes place. So this doesn't affect the PNL. This doesn't create a volatility in the PNL, which is why hedge accounting is preferred for derivative contracts. Simple. Let's dive into this further, but hope you understood why we use hedge accounting and not derivative account. It's a choice. It's a choice basically. If you prefer to use that, if the volatility is not that high expected out of the derivative contract, use the normal P&L method. Don't add complications like fair value accounting, cash flow hedge accounting, or whatever. But if your investors are really concerned about this volatile EPS figure and all that, then I think you should make this a consideration. Rather, otherwise means the definition of a derivative would not be accounted for as a financial instrument the company enter into for the purpose of receiving. Yeah. So this entire thing means that if this wheat that we are getting, this wheat contract that we are, hedging, you know, if that is for the purpose of trading, we are going to trade those, wheat contracts or whatever for a higher price, or, get gains and losses and whatever. If it's for trading purpose, then it meets the definition of a derivative and you should do derivative accounting, the P&L accounting, whatever. But if it is not meeting that, if it is for their own purpose, if that wheat is used for making the bread by the business, then it's a normal inventory item that you should use IAS to inventory payables out there, and it's not derivative at all. It is just debit inventory, credit payable, debit inventory, credit cash, whatever recording entry is there for, inventory. You're going to recognize it like, it's just like normal future. You're going to take that you are going to do a transaction in the future and you're just doing that. You're going to do a transaction in the future, and normally how do you account for it? Debit inventory, credit payables, debit inventory, credit cash, however it is. That's all. So this is that only. This is just saying that if it is for own purpose, then it is not a derivative. That's all. So it is just a normal accounting. So make sure this is not for own purpose. Sometimes in this scenario will be there that business is using it for own purpose. It's for business purpose, or you felt from the scenario it's for business purpose. Understand it that it is not supposed to be. In the case of a derivative contract, then it does not meet the criteria for derivative accounting. So insert enter into a forward contract to buy fuel, which has to be settled on 31 December. Uh, okay, let's discuss this further, and then if we need, yeah, we are going to discuss about hedge accounting also. So is the remember the fuel was to be physically delivered to the head office and to be used by insert to head its premises. The fuel was not for resale. The contract should not be settled through the net cash settlement. A penalty was payable if insert, okay, not settled through net cash settlement, and penalty was payable if insert did not take delivery of the fuel, had never failed to take delivery in the past. Okay, so there's some fuel it wants to heat with premises and all for that. So let's identify how it should be accounted for in IFRS 9. One more thing in SBR exam is that you don't necessarily have to rely on numericals. It's more of, how do you apply your IFRS standard in a particular scenario. So if numericals are important, of course, if they are given, then you should use them. But it's more of how you're applying the standard. So you should be very well aware of IFRS standards more than how it was in FR exam. In FR exam also you should be, but in SBR it's more of logically applying the standard. So IFRS 9 should be applied for those contracts to buy or sell that can be settled net in cash. The exception are those contracts that are for the purpose of entities' expected purchase, sale, or usage requirements. What we just read, what we just understood in the above case, wheat and bread case. Therefore, in this case, IFRS 9 does not apply to the fuel contract as it will be physically received and used in the company's business. The keywords, guys, physically delivered to the head office and to be used by insert to heat the premises. There itself, you should have understood. So, and not net cash settlement. So, these are all keywords that you should apply. So, it's not it's a, uh, first of all, it is for a non financial item. Okay, the fuel thing that can be settled net in cash. Here, it cannot be. So, it is not meeting the criteria. And therefore, IFRS 9, the derivative contract thing is not going to be applied. So this, as insert has never failed to take delivery and the penalty or penalty is payable if insert did not take delivery, it is unlikely that there will be net settlement. So what happens in net settlement is that, we try to use derivative contracts. We try to net it off against the actual hedging item. What happens if for example, there was a loss in the fuel contract? Okay, maybe we are trying to buy fuel, right? So maybe there was an increase in the price uh, and increase in the price of the fuel, the hedge item, and the hedging instrument, that is the derivative contract that we're using, that 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 faced a gain. Okay, we had fixed our cost in of the fuel according to that. So now what we say is that if we are going to use it for trading purpose, if we would have used it for trading purpose, the business, insert business, then what they would have done is they wouldn't accept the delivery. They don't want this thing for delivery. They don't want this in their inventory item. They just want to trade it. They just want to get gains using the derivative contract. So that means that they will account for, that is another proof that it is not a derivative contract. Here it is going to be they are going to accept the delivery of this fuel at any cost. Take the delivery of the petroleum at any cost. That means they're not trading it for net cash settlement. They're not trading it for profit and loss and all. They're trading it genuinely for using it in their inventory or using it for their business purpose, and which is highlighted already. Two reasons are already highlighted for that. But this is the third reason that you should try to state, because every possible thing that comes from the scenario, that is an evidence, should be collected, and therefore the conclusion should be made in the SBR paper that okay, this is the reason why this is not a derivative, and IFRS 9 won't be applied. And therefore, IAS 2 will be applied, where you will accept the item. You will say what is the cost, what is the NRV, you will see lower of them, and you will value the inventory accordingly. And if there's any payable that is supposed to be made, of course, include equal to the price that was agreed with the supplier, payable will be recorded for that. Or if it's cash basis, you will pay cash. But it doesn't seem like it's cash basis, because doesn't seem like it. Maybe payables contract will be there. Let's see. I mean, we don't know. I mean, not let's see. We don't know. So this is about it. This is what you're supposed to answer. This is how you're supposed to answer. This is the logic behind it. Simple, guys. Nothing to overthink in this. Now, hedge accounting, as noted above, derivatives are used by companies to manage risk. In the financial statements, they are remeasured to fair value at each reporting date with a gain or loss recognized in P&L. However, the item that was generating the risk may not be recognized in the financial statements, such as future purchase of wheat, or it may be accounted for in a different way, like inventories or wheat, which are measured at lower of cost in RV. Exactly. So, okay. This gives rise to an accounting mismatch. This causes volatility in PRL and can make the company look like a riskier investment. Um, so basically, this is saying that in the above scenario, I already explained this, to be honest. Like above, I already explained it. If it's trying to say, uh, yeah. So it is trying to say that not be recognized such as future this is trying to say that any gain or loss coming in the P&L associated with the derivative contract won't be recognized in as part of the hedging item. Hedging item will continue to recognize as per lower of cost NRV, inventory item IAS2, that application will be made. None of the gains and losses coming from that contract, coming associated to the hedging contract will come up in that. So for solving that problem, hedge accounting is coming. Hedge accounting will incorporate whatever gains and losses are coming, whatever gains and losses are coming out of the contract, hedging contract, the derivative contract, that will be incorporated in the inventory item as well. That's all. Simple. This entire thing, entire big paragraph is saying this. Simple. So the hedge accounting requirements in IFRS 9 are optional. If certain eligibility and qualification are met, hedge accounting allows an entity to in the financial by matching gains or loss of financial derivatives, losses or gains in the risk exposures they hedge. Exactly. So, of course, if this is just saying that if the criteria is met for that eligibility and qualification criteria. So here it is there. Here that criteria is mentioned. Okay, that thing is mentioned here. Hedge accounting can be applied to the following examinable types of hedging relationships. In order to qualify, yeah. So it's actually saying the entire order to qualify the hedge must yeah. This is effectiveness criteria. But besides this, also there will be criteria mentioned in the exam also, which I will cover. One is criteria for hedge. One is criteria for hedge accounting. Yeah, see, a hedging qualifies for hedge accounting only for yeah, this is the same thing. I'm sorry, guys. This is technically the same thing. So, what I'll just try to not make it any more complicated. Sorry, guys. I also, revised this topic with you. And based on my knowledge, also, I'm trying to, like, let's decode it together. This is what is real, right? This sounds real. I'm trying to apply in real life scenario as well. And I'm trying to teach you guys as well. This is how we learn, guys. This is problem solving. So, yeah, hope you understand it. Hope you appreciate it. So the hedge accounting requirements are optional. Yeah, this is what I have to read. Fair value hedge or hedge of the exposure to changes in fair value of recognized asset or liability or an unrecognized firm commitment that is an attributable attributable to a particular risk and could affect P&L. Yeah. So for example, sometimes even unrecognized it's not necessarily an asset or liability. Even some transaction or some specific item that is going to gain and you don't have a name for it, but I mean, it could be an asset and liability category, but it is likely to affect the P&L. So you're trying to use fair value hedges where you recognize gains and losses in the P&L respectively. Cash flow hedges is to variability in cash flow. And fair value hedges, one more exception is that if sometimes if the item is an OCI item, for example, equity investment in OCI, then you recognize the gains and losses for the hedging instrument also, derivative contract also in the OCI like that. That exception is there. Fine. So wherever that item is pertaining to, we'll record the hedging instrument gains and losses there. Cash flow hedges exposure to variability in cash flows that is attributable to a particular risk associated with a recognized asset or liability or a highly probable forecast transaction and could affect P&L. So, okay, it could affect the P&L. It's a forecast transaction. That means it's going to appear in the future, not now. So, it won't touch the P&L until and unless we don't. that transaction doesn't take place. So it is in the OCI, and OCI is not as relevant as PNL to the investors, because OCI, they think like it's like extra dump, that not technically an extra dump, but they don't take it as seriously as the PNL. And secondly, EPS comes from total profit after tax, less any irredeemable dividends or whatever, dividends on irredeemable shares or whatever. That's a different thing, but it comes from there. So again, OCI is not considered there. So that's not a relevant figure for investors. So therefore, this thing ensures that volatility is not there in the profits. I already explained this. So going forward, hedging relationship qualifies for hedge accounting if the following criteria is met. So please ensure you know this criteria. Don't learn it. You should know it, because this will help you to further, understand the keywords. You will be able to match the keywords with the concept that you're learning here. So please understand that. The hedging relationship consists only of hedging eligible hedging instruments and eligible hedge items. Okay, that means, as discussed above, eligibility is already discussed. Wheat should not be used for personal purpose, business purpose. Net cash, that thing that what we say, net settlement, physical delivery of the goods, blah blah, all already explained. That is the eligibility criteria for the hedge item and all that. Then all the inception of the hedging relationship, there is formal designation documentation. There's whatever that word will also be mentioned, that the company has all the formal designation and documentation confirming this relationship, um, and confirming the use of the derivative contract and all that. So that is also another word that will help you to identify, okay, this qualifies for hedge accounting for sure. That definitely the question is surrounding hedge accounting. And hedging relationship meets all the hedging effectiveness criteria that we'll discuss further. Uh, Hedge effectiveness is further described here. In order to qualify the for hedge, the hedge relation must meet the following effectiveness criteria at the beginning of each hedge period. There's an economic relationship between the hedge item and the hedging instrument. That means it should not be like, there should be some economic relationship. There should be some, you know, let's say, profit and loss thing coming up, or how do I further define this? Basically, they should be related economically. Like we should be able to find out the profit and losses coming out of it. Should not be related to a derivative of some other thing. Or if you're finding derivative, it should be linked to this particular item, and such that we'll be able to measure the gains and losses and find net settlement, find the net gain or net loss. So somehow it should be related that way. Then the value, the effect of credit risk does not dominate the value changes that result from that economic relationship. So sometimes what happens is, it's unlikely that you are selling an item to a customer, okay, and it's a large customer, but currently it is facing issues, okay, bankruptcy issues and all that, and you are going to sell it in the future. You are like, it's a large customer, he will eventually pay it, no worries. Okay, so you're trying to even take a derivative contract for that, to ensure that if any loss happens, let's say bankruptcy risk happens, or they are gone, like, I mean, business wise, then you have the derivative contract to ensure that at least you get the amount that you desire, okay, from that customer, using the derivative contract, like gains and losses and all, you will gain from that, and you will not lose entirely your amount, basically. But this is what it's saying, that it should not be the credit risk of that particular customer or of that particular receivable affecting you. It should not be that. That should not dominate this economic relationship. That should not decide the gains and losses coming out of the hedging instrument. So you cannot technically, let credit risk be the dominating factor in this economic relationship. Otherwise, it won't meet the hedge effectiveness criteria, and therefore you won't be able to utilize hedge accounting. So that's also important. Then the hedge, okay, to some extent, credit risk is okay, but not like a dominating part. There should be other risks as well associated, change in fair value, change in prices, blah, blah, other criteria, other risks as well. In the last one, the hedge ratio, the hedging relationship is the same as that actually used in the economic hedge. That means, like, of course, this means what? Where is my pen? Wrong. My hedge accounting, my derivative contract covers 1000 barrels. and my hedge item is also 1000 barrels of oil or petroleum, whatever. So it's exact one to one relationship, equal relationship. My risk, my actual uh, underlying hedge item, and my hedging instrument both are equal. However, if my this is the economic risk basically, what I'm trying to hedge using the derivative contract. Okay, but if, for example, if I had my economic risk would be 800 associated to the barrels, and in my that means my underlying hedge item would be 800, while I am trying to probably overhedge. There can be a situation of overhedge. 1000, is it effective? No, clearly not. It represents 80. It's what we say. It's a 8 by 10 thing, which is not effective. It should be 1 by 1. Similarly, if it is 600 here, the hedging instrument, it's an under hedge, so it's not hedge effective. So it has to be hedge effective for sure, and only then we can ensure that uh, this can qualify for hedge accounting. So this is the thing. It's very simple. Nothing to get afraid of, right? Now, if a hedging relationship ceases to meet the hedge effectiveness requirement relating to the hedge ratio, but the risk management objective remains the same, the company adjusts the hedge ratio of the hedging relationship so that it meets the qualifying criteria again. This is called rebalancing. An entity discontinues hedge accounting prospectively only when the hedge relationship ceases to meet the qualifying criteria after any rebalancing. So the thing is, yeah, it's just trying to say that if, for example, in our case, we have tried to overhedge 1000. The 1000 is the number of barrels we are trying to hedge. We will try to adjust it again. We'll try to probably either increase this to 1000 maybe, or that's not highly unlikely. We'll try to hedge only for 800, and to be made to make it equal to our economic risk, to make it equal to the number of items we actually want to hedge. That's all. We just change this to 800. This is rebalancing effect, so that this hedge effectiveness criteria is met. And after this also, if they find out that okay, this does not really meet, maybe because of other reasons, other criteria is not being fulfilled or whatever, then we will try to discontinue the hedge accounting, because now it does not meet majorly the hedge effective hedge what we say accounting criteria anymore. It does not qualify anymore. So this is the thing. Fair value hedge accounting, if the fair value meets the qualifying criteria, the hedging is just remeasured at fair value. The gain or loss is recognized in P&L. The carrying amount of the hedge item is adjusted for the gain or loss attributed. Yeah, I mean, anything associated to the gain and loss for that particular hedge item in P&L, the hedging instrument, the derivative contract will also be, the gains and losses will also be recognized in P&L. Similarly, in OCI, then in OCI. Simple. Wherever you are accounting for it, wherever PNL is, either it is affecting PNL or if it's OCI, respectively, you will account for it. So majorly the exception for OCI thing, accounting for it in the OCI thing will be, for equity instrument designated at fair value. So we have made investments in equity, and that's meeting the criteria for other comprehensive income. We are recognizing in OCI, and at the same time, the hedging instrument, that is derivative contract, gains and losses also in OCI. Simple. So this exception clearly lies there. So again, exam scenario, you should know that you should not get confused. You should not recognize the hedging instrument gains and losses for an equity instrument recognized in OCI. For that, you should not recognize the gains and losses for that hedging instrument in P&L. It is affecting OCI, recorded in OCI. Then afterwards, when cash flows, again, cash flow also, it is saying the same thing. And yeah, then it's also giving a question for the same. So cash flow hedge, if the cash flow hedge meets a qualifying criteria, the hedging instrument is remeasured at fair value. Gains or losses on the effective portion of the hedging instrument are recognized in OCI. These amounts will be taken to a cash flow hedge reserve as a separate component of equity. The ineffective portion of the gain or loss, I want to annotate, to be honest. The ineffective portion of the gain and loss, why is it coming here? Okay, cross. The in Okay, I can't even do it. Yeah, so the ineffective portion of gains or losses, yeah, the ineffective portion of the gain or loss on the hedging is recognized in statement of P&L. So what happens, what it is trying to say is that if your gain and loss is, in the OC, or we'll better understand this through an example in from one of the rest of understandings. When cash flow related to the hedge item are reported in P&L, amounts in OC are reclassified to the statement of P&L. So what happens is when the transaction takes place, when the actual transaction takes place, you're going to buy the inventory at any cost, or whatever payables transaction, whatever you're going to make, whatever cash flow hedge it is, when that hits the P&L, you will automatically, whatever gains and losses might have come up in OCI will be recognized in P&L. So that that matching effect is there, and the things are relevant for that particular year. Because see, cash flow, if that cash flow is coming or the transaction is taking place in the future, does it make sense that you are recognizing the profit and loss for that hedging instrument or derivative contract in very much past years in the P&L, while the instrument is, while the actual transaction is actually taking place in the future? Does it make sense? No, right? There's a mismatch of the timing. So if you know, there was a recent thing that took place, not similar to this problem, but around this problem, this accounting mismatch problems related to IndusInd Bank. Like that, what they had done is they had not accounted for mark-to-market transactions. There were some derivative contracts that they had. They didn't, not some, many actually, 1,500 crore worth rupees. So they did not recognize it correctly. They used did not recognize it according to market, and therefore their gains and losses were recognized in some other period. And while when the actual sale of those assets took place, the hedged item took place for which we are using the derivative contract, they were not they were done at cost. So this mismatch caused a lot of losses to the firm. And this because they sold it at a loss probably, or they recognize the gains from the hedging contracts or the derivative contracts quite prior, in the prior years, because that's how it was. But the actual item was hedged using the normal cost accounting or whatever, and I think swap accounting, if I remember. So because of this mismatch, lot of losses took place. So this is what we are trying to reduce. We are trying to eliminate this mismatch using hedge accounting, and which is why this is more favorable. So, where a hedge or forecast transaction results in the recognition of financial asset or liability, the gains or losses in the hedging instrument that have previously been recognized to OCI are reclassified in the same period as the asset or liability affects a P&L. For example, in the periods when interest expense or income is recognized, if a hedge forecast, yeah. So, so for any liability, for example, if it's a loan contract as well, if there's an interest expense associated with that, we'll whenever we recognize that, we'll also reclassify the hedging instrument profit and loss for that in the same period. Similarly, if it's an income coming, whenever we are recognizing the income, we'll also recognize, for example, if we have made an investment, any incomes coming out of that, interest income or whatever, we'll try to recognize that hedging instrument gains and losses then and there only in the P&L. If they are not in this period, then we recognize in OCI the hedging instrument gains and losses. And when once they are done in the future, once they are recognized in the P&L in the future, we'll reclassify our OCI gains and losses related to hedging instrument into the P&L. That's all, guys. Simple. I've repeated it tons of times now, seriously. So I think you should get to know it by now. If not, revert back, redo, understand it. So the company removes that amount from the cash from, and includes it directly in the initial cost or the carrying amount of the asset on the liability. Wait, if a hedge forecast subsequently results in recognition of a non-financial run, yeah. So cash flow hedge and yeah, so what happens is whatever gains and losses you might have recognized in the cash flow hedge reserve, we just like a revaluation surplus, which has all the revaluation gains and losses for our revaluation modeled assets. Similarly, we create a cash flow hedge reserve where we take all our OCI gains and losses into that cash flow hedge reserve, which comes under equity section of the balance sheet. So it is saying that we will adjust our gains and losses if, for example, if it was not it is not a transaction affecting the P&L, it is a transaction associated to some asset or liability which will lead to a future recognition of asset and liability. Simply whatever cash flow hedge reserve gains and losses will be there, it will be adjusted for in that asset and liability. For example, it's an it's resulting in a payable, or let's say it is resulting in an inventory item. It's resulting in inventory item. It initially it was just going to be a transaction, normal cash flow transaction, or some other thing not associated to an asset item. But now we realize that no, it is an inventory item. So what we do is we simply recognize the gains and the losses both from that hedging instrument, which goes in the cash flow hedge reserve in the balance sheet. Let's just write it down here. Okay, where is my this? Yeah. Balance sheet, cash flow hedge reserve, under equity section, whatever gains and losses are there, it will go and be adjusted to the carrying value of the inventory. So you continue to recognize it according to lower of cost and NRV, but you will also include this gains and losses associated with the item in the inventory. You will adjust for it on that which year when this is realized. It is realized that it is supposed to be recognized in the balance sheet. It is a balance sheet item, not beforehand, not as soon as the hedging cash flow hedge reserve is opened, or not as soon as the hedging instrument makes gains, but when it is going to be recognized in the inventory, or when it is realized that this transaction that we are hedging for is actually an inventory item, and we are going to recognize in gains and losses there. Sorry about it, guys. Just I'm speaking a lot, so it happens. So and includes yeah. So this is not a reclassification adjustment, and hence it does not affect other comprehensive income. However, if a company expects that any of a loss recognized in OCI will not, yeah. So basically, reclassification adjustment means you are just simply, if there was a gain recognized in OCI in 20 in 2024, there was a gain recognized in OCI, maybe of 2 million. And now in 2025, this transaction took place and you want to reclassify in the P&L. So what you will do is you will record this 2 million thing in P&L, right? Okay. So what you will do is debit the OCI for that gain and credit the P&L for that gain. You are going to increase the P&L. So this is what it is saying. Okay, guys. So this is reclassification adjustment. But in our case, we are directly dealing with balance sheet items, cash flow hedge reserve, and the inventory item, the asset item in our example, which I said just now. So this is nothing to do with this reclassification adjustment happening between OCI and P&L. So this is what it is trying to say. Then afterwards, however, if a company expects that any of a loss recognized in OCI will not be recovered in future periods, it should reclassify to P&L the amount that is not expected to be recovered. So if a company expects that any of a loss is, basically it means that if the transaction won't occur in the future, you're not likely to take up the machinery item, or you're not likely to take that inventory item in the future, then simply don't recognize this anywhere else. Just do a reclassification adjustment by transferring whatever losses or gains you have associated with that hedging instrument into the P&L. That's it. It's just like I'm saying that taking the hedging instrument was a waste, and it did not prove to be effective because I didn't buy the machinery item, or the transaction didn't occur anymore. So it's no point putting that in the OCI. So it will create a bit of volatility because the cash flow hedge accounting did not prove out to be effective here. We did not buy the item here, but it was just going to be for that particular year when we make this reclassification, because in next year and all we might possibly not take this cash flow hedge anymore. Company might try to take it only if it is highly probable the transaction will take place for sure, and such unforeseeable situations won't happen, right? So this is the thing. If the transaction not occurring, we'll recognize that we'll just do this reclassification. That's all it's saying. So because we don't have anything to adjust the cash flow hedge reserve against, or we don't have anything, any item to see, some item should be there against which we can do. Na? This is the whole concept of hedge accounting. Some item should be there for in which we will adjust these gains and losses. If the item itself is not there, where we'll adjust this? Of course, we have to do this OCI to P&L adjustment. We can't transfer it to any asset or liability item, of course. So this is what it is saying. Simple, guys. So next, let's get into the question, hop into the questions. And sorry about this, guys. Let me just erase it off. I mean, yes, okay. So, as a result of economic turmoil, this has stopped purchasing raw materials. Ability of customers to buy from mailings has also been adversely affected by the economic difficulties. Highly probable Future material and sales of finished goods were designated as hedge item in cash flow hedging relationships. So, do you think it's going to be successful? I clearly don't think it's going to be successful. Yes, so hedge accounting will be discontinued for sure. I can like read and understand it because based on what I just explained you now. So, what is the potential effect of the economic turmoil, ability to help and the effectiveness of hedge relationships? Because of the economic circumstances, mailing company no longer intends to purchase raw materials. Its customers are likely to be a similar position. These transactions, so neither mailing is in a position, neither the customers. So clearly, both of them are suffering. So basically their business is in a critical condition, of course, and they can't, it's highly unlikely that they'll be able to make this transaction. They had a cash flow hedge. uh, they were had the both of these items, customer items, that is what we say, sale of finished goods also, and future raw material. Both of these were hedge items. They had hedge all both of these. They had taken derivative contracts for both of these. Now both of them are going to fail. There's clearly a scenario like that. So if they are no longer highly probable, then these are not eligible hedge items, and so hedge accounting must cease. When the expected timing of a designated hedge transaction changes, an entity is required to reassess whether the hedge transaction identified in the hedged entity's hedge documentation is still the same hedge transaction. In other words, it must assess whether the hedge transaction is still expected to occur. And yeah, of course, when such circumstances happens, you would have to reassess your situation about that. So if as a forecasted transaction is no longer highly probable but is still expected to occur, the entity must discontinue. Yeah, and defer the gain or loss on the hedging that has been recognized in OCI, accumulated until the forecasted transaction occurs. So here it is not clear if this will happen, right? If the forecasted transaction will happen. They have just said that highly probable future raw material. Yeah. So it is not exactly mentioned that the forecast transaction won't happen. It is likely that it won't happen. We are just, as accountants, going to suggest them, as SBR experts, we are just going to suggest them that okay, this transaction is we have to reassess the situation. It is likely that it won't happen. But if you want to play a bit more fair, just be like, we are not sure here about the scenario if the forecasted transaction will occur or will not occur, but we will mention what will happen in each of the scenarios respectively. So in case if it occurs, we are going to recognize in OCI accumulate in equity until this occurs. That means OCI gains and losses going in cash flow hedge reserve, which is under equity item. And once this occurs, once the transaction occurs, if it is an asset item, we'll adjust this cash flow hedge reserve gains and losses in that asset item. If it is a PNL item, PNL affecting item, we'll simply just reclassify in the PNL whatever gains and losses we got. Right? Similarly, if the forecasted transaction is no longer expected to occur, we are expressing the scenario in negative as well. If it is not expected to occur, we will simply recognize whatever gains and losses till date we had occurred, till the date when we got to know that there are a lot of losses and no longer probable transactions are going to happen. We are simply going to recognize the gains and losses coming from the OCI to the PNL. I explained all of this now in the above scenario. You can revert back and check it. So note that a change in the timing of a hedge forecast transaction or increase in credit risk may also cause a hedging contract to fail. Yes, correct. Hedging credit risk should not dominate the economic relationship. We clearly read it here. This one above. This should not dominate the FS. So hedging effectiveness criteria is anyways not maintained, not met. So we can already say that it is likely that we are not going to apply the hedge accounting. So you can give that as also as a reason. So this hedging contract to fail the hedge effectiveness. Yeah. So if hedge effectiveness is failed, then hedge accounting will also fail. Simple. So then question 3. Yeah. So okay, cash flow hedge accounting came up here also. So I think I don't have to cover 1 minute. Cover this example from the study text. It came up here. Last thing from the scenario, not going to bore you anymore. I hope it was interesting, guys. For me, it was interesting, really. So Review is preparing its financial statements for the year ended 31 December. Review wishes to protect itself against a foreign exchange risk arising on 3 million dinars, which it expects to receive on 31 Jan 2028. So future transaction criteria met. Now Review enters into a forward contract on 1 November to sell $3 million on 31 Jan 2028, designating the contract as a hedging instrument in a cash flow hedging relationship. Management assesses the hedge to be effective. Okay, that means that the relationship or the all the criteria that we mentioned above that are being met. Okay, uh, the relationship, the credit risk not dominating, the hedge ratio, all of that. So on 31 December, the currency contract has positive fair value of 1 lakhs, which is matched by decrease in the fair value of the forecast cash flow of 98,000. Okay. The source of hedge ineffectiveness was analyzed and it was deemed that the hedge effectiveness criteria were still met and that no rebalancing was required. So again, they try to see again uh, Mm, on maybe that's a year end, that's why, yeah. Year end, they try to assess it again and see if any rebalancing is required because it should not cease. Because they might be, accountants might be doing all of the accounting, they might be summing up all of the accounting and gains and losses and cash flow hedge reserve, everything, all these balance sheet items will be affected. So that they have to see by the year end what will be the effect. So they will see that we will do hedge accounting only if hedge effectiveness is met, right? And that is met only if hedge ratio is also met. So they will reassess the hedge ratio if any rebalancing is required or not. So this is why in year end also they will make this assessment. So see, think logically. SBR is not like all of these accounting standards were made logically. To be honest, I believe that there was some of the other logic applied, and therefore this is what they have come up to. Here also this logic has been applied, and these standards are not for meant for learning. It is meant for genuinely, using logic, I believe. So then only then the subject will be interesting, to be honest. So think that way, guys. So on 31 Jan, a review received the expected 3 million runners and terminates the currency contract, which has a fair value of 104,000. And so that is the date when transaction took place. Okay, so there was no hedge in it. Yeah, so at the time when the cash is received. So maybe it's cash accounting basis, that's why this is mentioned. And they expect to receive 3 million dinars. So probability is still there. And it is still probable, we still recognize. Yeah, so this is actually trying to prove that net settled in cash that I mentioned before. If it is cash based also, that is also one of the derivative contract criteria, net settled in cash. So this is just trying to say that it's like net settled in cash. Technically, we are not making the sale. It's more like we are trying to trade the derivative and try to gain from it. So it's just trying to say that it is meeting the derivative contract criteria, and therefore you can apply hedge accounting for the derivative contract, because hedge accounting is specifically for derivatives. If you don't have a derivative, if you don't have a hedge, then hedge accounting will fail. So derivative contract definition should also be met, guys. That's also one more criteria. So, guys, let's get started. Accounting will be, this is how it will be tested in SBR. No one's going to ask you to do the entire, what we say, there's no MCQs. Numericals and all will be there, but it's like just like this, how it will affect. If you're not good in journal entries, also, it's okay. You can at least try to say that actually for this type of question, you should be okay with journal entries, because how will you show the effect otherwise of whatever it is, whatever you're trying to explain? But if you're not also, it's okay. Logically, you should be able to see the OCI will be effective. We'll credit the OCI, we'll debit this. But in case if you're, of course, if you're trying to say OCI debit credit, you will be able to pass a journal entry as well. But try to practice the journal entries, I would say. So the effective portion that is matched 98,000 increase in fair value is credited to OCI as a lesser of the community. Yeah. So what it is saying that the forecast cash flow of 98,000, the currency contract is a derivative contract. Okay. This is forward currency contract. It is 100,000. While this is the actual cash flow transaction taking place is 98K. What does it mean? It means an overhead has taken place. Simply $2,000 extra we took. And this is not like the companies did it on purpose. Sometimes what happens is they have tried to, they only got this size contract. They could not help it. Maybe they did not get this 95,000, 90,000 contract size. They got this 100,000 contract size. Usually it happens like that. You will notice that in AFM exam. So because of that, they could not help it. They had to take this contract as it is, and therefore it became an overhedge. Now it became overhedge, so that $2,000 is not a part of our hedge, right? We are only trying to hedge that 98,000. So we'll just focus on this 98,000. Okay. So that's why it becomes the effective part of the hedge. That's why it is mentioned effective part. Match the effective portion of the hedge, that is the matched 98,000 increase in fair value, is credited to OCI as the lesser of the cumulative gain on the hedging. Yeah. So basically, it is trying to say as a lesser of the cumulative gain on the hedging instrument and the cumulative change in the fair value of the expected future cash flows. I mean, this is the gain, yeah. This is matched by decrease in the fair value of the forecast cash flow. 1 minute. It has a positive fair value of 100,000. So basically, what it means that I'm just going to account there was a if there's a decline in my forecast transaction hedged item, if there's a decline, clearly we should assume that there has been an increase in the derivative contract. This is what it's trying to say, and you should always assume this regardless of this question. If there has been a decline in your hedged underlying hedged item, the item which you are hedging, there is definitely a gain in the hedging instrument, the derivative contract. So my gain here is going to be equal to the cash flow item, the effective portion, the 98,000, because that is what is pertaining to my cash flow. Rest is all overhead. I don't care about that. That will go in PNL. But this part should come in the OCI for sure. This 98,000 out of this 1 lakh, 100,000. So 98,000 will go in OCI. Well and good. And derivative will, of course, that 100,000 will entirely go in debit because we are trying to remove that liability, that derivative contract. We are debiting it. That's how it is. And remaining 2,000, as I said, it will go in PNL because that's the ineffective portion. We don't care about that portion. We did not ask for hedging for that portion. It is not relevant to us. We are going to throw it in the this PNL. We are saying that no, this is not a part of our hedging instrument, hedging contract. We didn't ask to hedge for that, so we'll not. It's not pertaining to us in the cash flow hedge. So we'll throw it there. Now on 31 Jan, this is the date. Yeah, mention the date. Okay, this is the ineffective portion as already mentioned. Yeah, this is how you'll describe the transaction. Then afterwards, mention the date as well. It's important because this date changes to place. The fair value has increased by 4,000. So basically 104,000. So basically, it's like this date, the currency contract was 100,000. Now it became 104. So therefore, there was a gain. So we can say that. So on 31 Jan, the fair value of the hedge was increased by 4,000. However, the hedge is now fully effective, so that the cumulative amount in OCI needs to be reflecting the entire 104,000 increase in fair value. Okay. So what it is saying that hedge is now fully effective. It is telling us in the question there is no hedge ineffectiveness. That means we are this 104,000 accommodates for that entire cash flow hedge that we were trying to that transaction that we are trying to hedge. It is telling us we don't have to overthink this. It is telling us it is going to cover the entire cash flow hedge. You don't have to worry about anything. So we will try to recognize this 104,000. We'll try to increase this to from 98,000 to 104,000 because now this is pertaining completely to our cash flow hedge, right? So how much is the difference? To yeah, 6,000 is a difference. So 6,000 gain from that 98,000, 6,000 will come in OCI. Well and good. How much was the currency contract that we already recognized? 100,000. Not recognized, I mean already it was debited to 100,000. So 4,000 extra will be debited. Okay, on 31 Jan, the next year. And after that, what was the remaining? Remaining that PNL that was ineffective, uh, that ineffective hedge that had happened. Sorry, where is that? Here, that ineffective hedge that had taken place previously, that will be debited. That will continue to be debited pertaining to the transaction. So that's how it will be adjusted. And so basically, it's like that: 4,000 plus 2,000, 6,000. Debit credit is matching. So that way also you can understand this. Then on 30 and 31 Jan, the cumulative fair value in equity must be reclassified to PNL when the transaction is completed. Yeah, so this is pertaining to a transaction happening in PNL, right? So we'll try to just whatever gains we got from there. So let's say whatever was created to OCI, 98 plus 6. that is 104,000, that debit the cash. No, debit the OCI and credit the PNL. So it's not like we say debit the cash flow hedge reserve. We say debit the OCI and credit the PNL with that 104,000. That's a journal entry. So what it is, debit cash and credit currency contract. So guys, one more thing that I kind of forgot to tell you, that this is not a liability actually. How we decide if a derivative is a liability or an asset? So if there is gain, which is clearly that in the case, in our case, there was this, it's clearly fair value gains are there, positive fair value. All of these are keywords for you to understand that derivative here is an asset for us. So that is the case, we will simply write debit the currency contract, the derivative. So I kind of described it as a liability, but that was wrong. That is not a liability. And finally, if it is when it is settled, also we will debit the cash that we receive, the gains that we receive, and we will credit the currency contract. Like it's like telling that okay, the asset is over now, we have settled it now, and the currency contract is gone out of our balance sheet as an asset. So this is what it is. So guys, hope you understand this entire scenario, ineffectiveness, effectiveness, how this works, how the accounting will take place, how to pass the journal entries, how the entire hedge accounting takes place, the criteria for it, the criteria for hedge effectiveness, the hedge ratio, what is the derivative, how we account for it, how does it meet for hedge accounting. All of this should be clear in your mind, and it should be like crisp and clear. Like, it should be very easy for you to answer this question now, hopefully. And if there's any doubt, ping me in, no worries, on Insta, LinkedIn, comments, anywhere, wherever you wish. Plus, try to share it with as many as possible. I'll try to decode it, and just hoping that you find it useful. Signing off now. So please do like and share, guys. Please, it genuinely encourages me, and I will try my level best to keep making more videos like this. And if there's any suggestion, also please do comment down. And okay, guys. Bye, guys. Bye.